I recently got a comment on my last net worth video, and the comment reads, "However, I feel like I'm starting my investment journey at an unsure time since I keep seeing people freaking out about a potential stock market crash. My question is, would you still recommend someone starting investing every week into VU in the current market, and how are you handling it?" Now, this question is a question I see come up a lot and is honestly a question that I had a lot when I first started investing. And it's a great question, right? It calls out what you see a lot, where people are going to constantly worry about stock market crashes and dips and uncertainty and how exactly to handle it. So in this video, I wanted to talk about why, especially if you're investing for the long term, you should never worry about a stock market crash as far as your investments go. So every time the stock market drops, the same thing happens. News outlets, especially on TV, or you're going to hear everyone's, going crazy. People, they're going to start predicting recessions. Social media is going to be filled with people saying it's time to sell, it's time to liquidate, whatever it might be, right? And I get it. Seeing your portfolio drop by thousands of dollars overnight or in the next few weeks isn't fun. It can make you feel like pretty much everything you've been working hard for, you're watching it all kind of dwindle away. But if you're investing for the long term, right? Now, when I say the long term, I'm talking about 10, 20, or 30 years down the road, then you should never be worried about a stock market crash or dip, because crashes will never be the end of your investing journey. They're just a natural part of it that you're going to have to learn how to take advantage of. And yes, 100%, while they feel scary in the moment, when you zoom out, every single crash in history eventually looks like just a small dip in a much bigger upward trending line. So today I want to talk about, once again, why you should not fear stock market crashes and how to actually take advantage of them. The first thing you need to understand is that the stock market crashes are not rare events. They actually happen all the time. The market itself moves in cycles. You have growth, correction, recovery, and then you see it repeat. So think about this, right? The Great Depression that happened in the 1930s, the dot-com bubble that happened in the 2000s, the 2008 financial crisis, and then even COVID. We saw a big crash in 2020. Each one, at the moment, felt like the end of the world. People genuinely believed that the market in those times would never see recovery, but it always did, and it always will. If you look at the long-term chart of the S&P 500, every crash eventually becomes just a tiny little blip downwards. So what might look terrifying while you're living through it, it actually ends up barely being noticeable in a few years, especially if you look at the long-term chart of the S&P 500. The problem is, we only ever hear about the drop. We never hear about the recovery unless you're really into investing news. News outlets make money usually from fear and not patience or talking about good things happening in the market. They usually get a lot of their views off of talking about bad things happening in the market. So if you're investing for the next 30 years and a 12, month crash happens, that should mean absolutely nothing to you. It's just another season of a much bigger story of growth. Now, this is a topic you've heard me talk about before, but time in the market will always be timing the market. And this goes to kind of that comment that I've mentioned in the beginning of the video. When people panic during a crash, it's usually because they also think they can outsmart it. They'll think to themselves, I can sell my stock before it drops any further, and I'll buy it back when it's nice and low. And while yes, that sounds great in theory, in reality, nobody does this right. And if there was someone that would do this right, they would be the richest person in the world, because not even professionals can get this perfectly right. Most people sell typically when they're scared, near the bottom, and then they buy back after it's already recovered. It's usually really hard to buy back at the opportune time. So now, by doing that, you've already lost twice. The truth is, most people who try to time the market, they end up missing the most important days. And those days are actually the rebounds. So there are studies that actually show if you miss just the 10 best days in the stock market over a 20-year period, you nearly cut your returns by 50%, which is wild. So instead of trying to predict when to get in or to get out, my philosophy is just to stay in. Keep investing on autopilot every paycheck, every month, every day, whatever you decide to do. no matter what is happening around you, because time in the market is always going to beat trying to time the market, and consistency wins every single time. Now, here's something most new investors don't realize. When I first got into investing, if you told me this, I probably wouldn't believe you. The best investors, the ones who build real financial freedom and wealth, they do not panic when the stock market crashes. They actually get excited because every crash is basically your favorite asset on sale. So if you love VU, right? VU is the one I recommend most people buying. If you love VU and it crashes 10%, your VU just went on sale for 10% to buy back. And the same stocks that you might have loved last month, they're now 20, 30, 40% off. Now, once again, that's not financial advice, but that's a good way to look at it. So if you walked into your favorite store, right, and you saw everything marked down 40%, well, you'd be like, yeah, it's time for me to stock up. And that's usually how these big investors make a lot of their money. But when the stock market does the same thing, everyone decides to panic. So it's all about philosophy and the way you look at it. And that's a lot of emotion talking. And it's weird to think that emotions play a big role in the stock market, but they genuinely do. The people who quietly buy when everyone else is panicking and scared, those are the ones who actually make the biggest gains when the stock market recovers. Now, Warren Buffett actually said this: be fearful when others are greedy, and greedy when others are fearful. So you don't have to go in. I'm not, once again, not financial advice, but I'm not telling you to take your savings account and throw it into the market when it dips 3%. You don't have to go all in, right? But the good news is you also don't need to time it perfectly. All you have to do is just keep investing consistently, because when you're buying through the lows, you're getting more shares for the same amount of money. In years from now, you're going to look back and you're going to realize those scary times were also the best times to actually invest. If you look at the best times that you could have invested your money over the past 20 years, it was all those dips I talked about: the dot-com crash, the 2008 financial crisis, the COVID crash. Hindsight 2020, those were the best times to actually start buying stocks. So what is the real risk, right? The real risk for your money is not the crash itself. The biggest threat to your portfolio will always be your emotions and how you react to a crash. Fear, especially when it comes to money, makes people do a lot of irrational things that you would look back on and be like, why am I doing this, right? When you see your account dropping, the instinct that every human has, even me, who has been investing for a little bit now, is you need to protect what's left. If you ever see my net worth videos, I have a decent amount of my net worth tied to the market. So if the market lost 40%, I would probably see a decline in my net worth by about 30, 40%. So you think, well, I need to protect what's left. But the moment you sell your stock, that's the moment that you lock in those losses. And the market, as I've said before, always recovered, literally always recovered. But the people who panic sell never benefit from that recovery because they're sitting on the sidelines waiting for it to feel quote unquote safe again. So here's the rule that helped me. If nothing about your long-term goals have changed, then nothing about your investing strategy should change either. You're not investing for this year. You're investing for the 30-year-old self of you, the 40-year-old self of you, the 50-year-old self of you, whatever it might be. So a crash will not change that plan. It just tests how much you actually have conviction in your plan. And the other thing too, crashes are temporary. Compounding will be forever. When you zoom out far enough, you start to see how small crashes really are compared to long-term growth of the market. The average bear market, when prices drop, say, 20% or more, it can last around, let's say 9 months. The average bull market, so when prices are going up, usually typically lasts for several years. So when you think long-term, a crash is not a setback. It's just usually a small pause. Meanwhile, if you keep investing through those downturns, once again, you're buying more shares at a cheaper price. So when things recover, all of that growth will start compounding on top of each other. And that's the power of long-term investing and why you shouldn't worry, because your money is going to always work quietly for you in the background while everyone else is just kind of panicking in the short term. And the other thing too is when you invest for the long term, you're not betting on a chart. You're also betting realistically on human progress. You're betting that businesses will keep innovating, that people will keep working, spending, building. That technology will keep advancing, right? And history shows that it does. No crash has ever stopped human progress. We've had wars, we've had recessions, pandemics, and yet the market always seems to recover. And it's not because it's magic. It's because people, human beings, we create value. So when you buy the S&P 500 or invest in good companies, you're investing in the progress of the human race, if you think about it that way. And the last thing that I want to say is this, and a lot of people don't like to admit this or, want to say that this isn't true, but in my opinion, once again, it's not financial advice. If you're investing in the stock market, like VU, and you're not stock picking, you should have full conviction that your money will always increase over time. Because in my opinion, the stock market is literally designed to go up, right? And this is something that not a lot of people talk about because they don't like to look at past results and predict future results, right? But let me explain what I mean. First, inflation is not going anywhere. Whether you like it or not, the cost of everything, food, housing, goods, is slowly rising year after year. And I don't care who the president is, I don't care what you believe in, this is a known fact that no matter who is in office or what's going on will never change. And what drives inflation? The simple fact that the government keeps printing more money. Because the government, no matter who is in office, we have a spending issue and are constantly in huge amounts of debt that we can't pay off. Every time the government prints more money and puts more money into the system, the value of each individual dollar goes down. So if you're just holding cash, you're losing purchasing power without realizing it. But the stock market, companies, real businesses, they adjust to this reality. As prices go up, companies charge more for their products. Their revenues increase and their stock prices naturally follow that trend. That's why over long stretches of time, the market has always outpaced inflation. And when you invest in stocks, you're not just betting on companies, you're literally buying ownership of the global economy. And as the world keeps printing more money and prices keep rising, those assets you're buying, like shares of VU, well, those shares become worth more in dollar terms. That's why every time, even after a crash, every correction, every quote-unquote unpredicted, unprecedented event, the market keeps setting new all-time highs. Because in my opinion, it's not luck. It is literally just math. It is math with inflation and the debt that we're in. And the system is literally structured around inflation and growth. The US economy is built to expand. Businesses will continue to innovate. Populations grow, money supply increases, and the stock market reflects all of that. So when you zoom out 20, 30 years, it makes perfect sense why the market line literally trends upwards. Because it's not optimism. It's just designed off the system that it's based on. So people who lose money are the ones who panic and sell during all the noise. The people who stay calm and keep buying, they're the ones that benefit from the system in the way it was meant to be used. That's why a lot of people say the rich keep getting richer because they know how to use the stock market. That's why if the stock market ever crashes, hold your money and stick to your plan because there's very high conviction that the system you're investing in, due to inflation, due to money printing, due to debt, is always going to go up. Now, once again, to preface this, not financial advice, and I do want to say, I'm talking about investing in the stock market like VU. Now, if you're picking individual stocks, that's a whole different game. You got to be a lot more on top of it. But if you want a stress-free investment strategy, buying something like VU, which tracks the stock market, and just consistently investing over time is one of the easiest ways to start growing your money. So if you guys got any value from this video, I'd appreciate a subscription and a thumbs up, and I'll catch you guys in the next video. Have a good day.